every cloud beat, every capex forecast went up. That's not just a headline, that's the entire story of the biggest earning day of 2026. So today we're breaking down what just happened across Microsoft, Google, Meta, and Amazon, and why the AI spending boom is not slowing down, it's accelerating. So let's start with the big picture. The four biggest players in tech just committed between 630 and 650 billion in capital expenditures for 2026. That's not a typo, and this earnings cycle was the first real test. Essentially, is all that AI spending actually working, right? And the answer is yes, across the board. So, and also that they're spending even more. So this isn't a slowdown story. This is the early innings of a full-blown AI infrastructure super cycle. So Microsoft came in hot. Revenue was 82.9 billion. That was up 18%. And then Azure growth, their public cloud, was 40%, beating expectations. And then AI revenue now is over 37 billion annually. So CEO Satya Nadella is calling this the agentic computing era, where AI doesn't just assist, it acts. But here's the twist. Microsoft raised its capex forecast to 190 billion. So that's way above expectations. And despite crushing earnings, the stock dropped after hours. Why do you think that is? Well, this is because investors aren't asking, is AI working? They're asking, how much is this going to cost? Now, of course, Alphabet might have had the most telling quote of the day, with CEO Sundar Pichai said, "We are compute constrained." So the translation is literally, they can't build AI infrastructure fast enough to meet demand. Key numbers were that Google Cloud growth was 63%, total revenue growth was 20%, and then the net income was up 81%. So, and just like Microsoft, capex is going up again. So now projected at 180 to 190 billion. Oh, and then they're already warning that 2027 spending will be even higher. So, and then Meta quietly put up one of the strongest quarters. The revenue was up 33%. Earnings per share beat expectations, and they had the fastest growth since 2021. What's driving all of this growth is AI-powered ads, specifically Advantage Plus. So this is one of the clearest examples of AI actually paying for itself. But here's the tension. So Meta raised capex again to as high as 145 billion. So now the big question becomes, can advertising alone fund an AI build out this massive? Because at this scale, we're talking about spending levels comparable to small countries' GDPs. And then Amazon, so they may have delivered the most balanced result out of all of them. AWS growth was 28%, which is the fastest in the last 15 quarters. Their operating margins were nearly 38%. And then revenue was $181 billion. But the real signal here was their custom AI chips, Cranium and Inferentia, are now running at a $20 billion revenue pace, growing triple digits. So that means something important, right? And that's that the AI stack is maturing from infrastructure to silicon to real revenue. So let's connect the dots on all these. So across all four companies, AI is driving real revenue growth. Cloud is accelerating fast, and demand is outpacing supply. So this is not the scenario investors feared. The fear was that, what if we build all this AI infrastructure and nobody shows up? Well, instead we got the opposite. Everyone showed up, and now we can't keep up. And then just a note on why stocks dropped after hours. It's really just simple. It's not about whether AI works anymore. It's about how big does this spending get, right? And how long does it stay this high? Because every company said the same thing. So we're increasing capex, not holding, not reducing, increasing. So here's the takeaway. So the AI infrastructure boom isn't peaking, it's accelerating. Big tech is making the bet that demand will not just catch up, but explode. And based on what we saw yesterday, they might be right. That's it for right now. If you want to stay ahead of the biggest shifts in AI, tech, and business, subscribe to Daily News. This isn't just earnings seasons anymore. It's the build out of the next digital economy, and we're just getting started. Thanks so much for tuning in, and we'll see you in the next one.